Today I want to talk about Tencent, which is the largest company by market cap in China. Tencent is massive. One way we could think about the company at a high level is that it's like Facebook, Nintendo, Google, Berkshire Hathaway, and much, much more, all rolled into one company. Tencent dominates in so many different areas. They're the #1 global gaming company by revenue. In China, they're the #1 mobile payments platform by monthly and daily active users. They are the #2 service provider by revenue for the cloud computing business. And of course, Tencent operates WeChat, which has over 1.2 billion monthly active users. The sheer dominance is truly astounding. Tencent is a massive company, and there's a lot we need to wrap our heads around. But hopefully after watching this video, you'll come away with some better understanding of some of the key concepts that will hopefully drive Tencent forward into the future. In this video, I want to discuss Tencent's core operating businesses. I'll touch on their huge investment portfolio. And then I've invited Frank from the Investing with Frank YouTube channel to talk a little bit about different ways that we can approach valuing Tencent. I'll leave a link to Frank's channel in the video description below. If you haven't already, I would highly recommend you subscribe to his channel for top-notch investment analysis. I'll also leave links in the video description below to some of the resources that I used to help make this YouTube video, including Packy McCormick's article on Tencent and Jordan Nell's excellent write-up on Tencent. Let me know in the comments below if you've had a look into Tencent so far. Okay, there's a lot to cover, so let's get into it. Right off the bat, we should probably start talking about WeChat. We might say that China runs on WeChat. Pretty much anything you need to do within your daily lives can be done through WeChat. One might even say that it is almost essential to everyday life. WeChat has over 1.2 billion monthly active users, and each user spends about 90 minutes per day in the app. Within WeChat, you can do everything from chatting with your friends, to hailing a cab, to paying off your bills. When I first heard of WeChat, I basically just thought it was another Facebook Messenger type app, but you can do so much more within that app. One minute you might be shopping online, and then the next minute you might be streaming your favorite video. WeChat has been crucial for Tencent's growth. Because of the huge user base within WeChat, they sort of have this flywheel effect going on, where merchants, because they want access to this huge user base, will open up shop within WeChat. And this is great for the customers because it provides them with more variety and more selection for the services that they want to use. And that in turn convinces more users to sign up for the service. And up until recently, Tencent has basically been a walled garden where other e-commerce platforms like Alibaba, for instance, were unable to list on any of Tencent's platforms. So Tencent was able to funnel their users to wherever they might want to go. For instance, Tencent owns an investment in Pinduoduo, so Tencent could at any time through WeChat funnel platform traffic to Pinduoduo, and that would deprive Taobao or Tmall of any of those customers. And once a merchant has access to this huge user base, there's really no reason for them to go to another platform because almost all of the customers in China are on WeChat already. So it's a wonderfully virtuous cycle where Tencent is constantly growing its repertoire of both merchants and customers, all the while taking a percentage of the transactions done on their platform. However, it does look like that new regulations are going to prevent Tencent from blocking off external traffic to other companies, so Alibaba might be a beneficiary from this new regulation. WeChat also offers these basically mini apps. They're called mini programs. These mini programs allow merchants and developers to quickly and affordably build apps that will keep them and the users that use these mini programs locked into the platform. These mini programs vary from everything including video streaming services to e-commerce platforms. To me, it sort of looks like WeChat is the fuel center, which provides growth for all of the other aspects of Tencent. WeChat also collects a treasure trove of individual data for its users, which allows them to provide personalized and targeted products for these users. Now, that's not a comprehensive overview of WeChat, but I hope you're beginning to see how important that flywheel effect that WeChat can provide for Tencent is to helping Tencent grow the rest of its business. Okay, next up, I want to talk about Tencent's gaming business. Now, it may come as a surprise, even to the most hardcore of gamers, that Tencent's gaming business is #1 globally based on revenue. We probably think of companies like Nintendo, Take-Two, Activision Blizzard, or even Sony and Microsoft when it comes to gaming. Every gamer knows League of Legends, PUBG, and Fortnite. But did you know that Tencent either completely owns or owns a large stake in all of the developers of these games? Tencent's gaming arm actually provides more than 30% of the company's total revenues, which is actually the largest share of any individual segment of their business. Riot Games, which is the developer of League of Legends and most recently Valorant, is a wholly owned subsidiary of Tencent. And Epic Games, which is the creator of the ubiquitous Fortnite, is 40% owned by Tencent. And what's interesting to note about that is Tencent owns 40% of a US-based gaming company. Tencent also owns 5% of Activision Blizzard, which is the producer of game franchises such as Call of Duty and World of Warcraft. Tencent's approach to growing their gaming business comes in a couple of forms. First off, we have seen Tencent buy complete control of other developers such as Riot Games, and we've also seen them buy non-controlling stakes in game developers such as Epic Games. They'll also develop games, sell them domestically, and license them overseas. Also, Tencent has a very important role in the world of esports. Basically, all of the esports in China run on Tencent's infrastructure. So that's another area where it's going to probably take a lot of effort from competitors to tear away Tencent's dominance there. From what I can tell, Tencent's financial business is pretty similar to what Alibaba offers with Ant Group. I recently did a deep dive into Alibaba with Frank over here, if you want to check that out, where I talk a lot about Ant Group. As of 2019, it looks like WePay's platform was at about 800 million monthly active users. But basically, WeChat Pay provides a lot of the same services that Ant Group does, including digital payments, micro-lending, insurance products, and things of that nature. There also is the possibility that WeChat Pay may end up being more regulated, like we've seen recently with the changes to Ant Group. According to Tencent themselves, Tencent Cloud is the number 2 provider in all of China based on revenues. As of the first quarter of 2021, Tencent Cloud is only 2% of the global market share in the cloud computing business. Its larger rival, Alibaba Cloud, only has 6% of the global market share. However, Alibaba Cloud is 4th in line to the throne. Amazon's AWS service still leads the pack with a whopping 32% of the market share. Cloud computing adoption is still at an early stage in China, so Tencent being positioned as the number 2 player already should bode well for them going forward. There's also the third competitor in China, which is Huawei, and they share about the same percent market share as Tencent. Alibaba has about 40% market share in China. All of these Chinese titans are investing heavily in their cloud infrastructure, and in the first quarter of 2021, Tencent spent over $600 million on cloud. In his write-up of Tencent, Jordan Els provided this excellent picture that describes Tencent's offerings in the cloud compared to Alibaba Cloud. Alibaba does have a more mature and complete offering in the cloud, but Tencent is getting there. It's really exciting to watch these Chinese cloud businesses grow because they are high margin businesses once we take into account the upfront infrastructure costs. So while the cloud business doesn't contribute much to the bottom line right now, it is an avenue for growth going into the future. So I'm really excited to continue to watch that grow. Of course, Tencent also has its hands in the media business. Notably, they have investments in companies like Spotify, Universal Music Group, and Snapchat. They also have about a 20% stake in a TikTok competitor called Kuaishou. There's also Tencent Music, which is the largest music platform in China. Tencent Video also provides competition in the long-form video space, where they compete against Alibaba and Baidu. So that's all the operating businesses, but I think it'd be interesting to take a look at the investment portfolio, because Tencent is more than just an operating business. Not only does Tencent have several dominant verticals within their operating businesses, but they also have a huge investment in portfolio that covers 700 companies. Of Tencent's top 10 investments, there are some notable names, such as JD.com, Pinduoduo, Tesla, Epic Games, and Snapchat, just to name a few. The portfolio is almost like a VC firm. It looks like Tencent has a strategy of either completely acquiring smaller companies or taking stakes in larger companies that they think have great opportunities for returns. With investments in home runs such as Pinduoduo and JD.com, it's really easy to see the brilliance of capital allocation at work at Tencent. I'm looking forward to studying that portfolio more in depth to really suss out what they're looking for in companies to acquire or at least take stakes in. Simply based on the top 10 positions in their portfolio, it's pretty clear that management understands what to look for as capital allocators.
Okay, so let's jump into a bit of a valuation for Tencent. I'll start off by saying that pretty much anything in China right now is fairly cheap. There's been a huge sell-off in the market, which is what is creating this opportunity. I'm just going to dig into the fundamentals of the business as well as their investment portfolio for my valuation. I'm not going to have any of the broader macro considerations put into place. So that will be up to you to make your own decision whether or not you are willing to take on the risk of investing into China, as there are some broad political and regulatory risks that come with any investment into China right now, including Tencent. So over on Twitter just the other day, I put out a tweet about the current price to earnings for Tencent, which they're currently trading at about 20 times earnings. At the time of the tweet, that was around 23 times earnings. Although one major factor that isn't put into consideration when you're looking at the price to earnings for Tencent is that for the price aspect of that ratio, we aren't considering the investment portfolio's fair value. And the market cap for the company overall is about 630 billion. So if we go back to our price to earnings metric and we actually back out or subtract away that investment portfolio that is not included and we add back on the net debt, then the price to earnings for Tencent is closer to about 15 times earnings, which for a company that has been growing north of 30% for about 10 years and has very high margins is extremely cheap. You can see on this chart here from Twitter that on a historical basis of their price to earnings metric, they are the cheapest they have been in the past 5 years. Currently trading again at about 20 times earnings, and that's not factoring in the investment portfolio. The mean or average price to earnings ratio over those past 5 years is 41. So we almost have a 50% discount to the historical averages. Of course, we can't rely on the multiple to revert back to the mean, but I do think it's fair to say that there will be some type of multiple re-rate for Tencent if it can continue to grow at the rates that it has. Now really, we can't dive into price to earnings metrics too much. That is just the surface level. So I've put together a Google Sheets to dive deeper into the valuation for Tencent. So let's jump in and have a deeper look. I have some growth considerations. If we want to value the company, we need to know how fast it can grow into the future. So the first thing I looked at is their historical growth, which is a small indicator for future growth. You certainly do not want to rely on it, but I always just like to consider it either way. So I have the revenue, earnings per share, free cash flow, and book value per share, which on average these have compounded at 34%. So the overall growth of the business over the past 10 years is about 34%. Probably the most important growth metric I like to look at is this value compounding rate, which we get from our return on incremental invested capital and timesing that by our reinvestment rate. I won't go into too much detail of how to calculate that in this video. I just do think it is a very good indicator we need to consider. So this 24% growth rate is a big indicator for me that I like to consider. Another one I look at is sustainable growth rate, which is just return on equity times the payout ratio, which gives us again about 24%. And here's another growth rate consideration that factors in some of the debt, which gives us a much lower growth of about 10%. Now, none of these can be relied upon on the future, and none of this considers the investment portfolio either, which is a big part of the Tencent business that I'll have a look at in just a second. But these can give us a rough idea of what this business might be able to grow at into the future. So the mean of these four growth rates that I'm looking at here is 23% and the median 24%. I'll be conservative and I would round that down a fair bit. So if we go over into my expected returns, you can see the growth rates I'm looking at over the next 10 years. So I'm doing this for both free cash flow and for sales. For free cash flow for the next year, I'm going to assume 20%, which is lower than that 24% average that we were looking at. After 3 years, I'm rounding that down to 15, then down to 12, and in the final 2 years of our 10-year valuation, I've rounded it down to 8%. I think those numbers are somewhat conservative. That's up to you to decide if you think that is right or not. Over the 10 years, that averages a 14.5% growth rate. I have no idea if that will be true, but I do think it is somewhat conservative. Now, looking at our expected returns here, I have free cash flow and sales, just to have two different considerations and multiples we think they can sell for in 10 years' time. So if they do grow at that rate, I think they could fairly trade or sell for a 25 enterprise value to free cash flow multiple. That is low compared to the historical average, which is closer towards the 35 to 40 range. So I think that is a fair assumption to make. That gives us our enterprise value in 2031, plus the cash less the debt to give us our market cap. We compare that to our current market cap, and that gives us a rate of return of about 12%. Cash on cash, that is 3.3. We do the same thing for the sales. I'm looking at a 6x EV to sales multiple. They're currently trading at 7, which is low compared to their average. That gives us about a 10% return per year. Cash on cash, that is 2.6. And this is only one part of our returns. So if we're doing a Davis double method of valuation, we look at the business growth, we look at the multiple expansion, and the dividend yield. I'm doing this over a 5-year time period because I think the growth will be higher in this first 5 years than it will out into the future. As the company gets larger, I think it'll be harder to grow. So business growth over this 5-year period, I've made an assumption of 18%. Multiple expansion, I'm going to say we get even more multiple contraction rather than expansion. So I have minus 1% per year. And then we add on our dividend yield. Those three factors are giving us our annual shareholder return over 5 years of 17%, which is over my personal hurdle rate of 15% that I do usually target. But of course, everyone is different with what they are aiming for. Our 10-year, I've slowed that growth down to the 14.5% average, and I've added some more multiple contraction. As we get larger, the margins might continue to get smaller, so maybe we see more multiple contraction. So I've put 2% per year, and again I add in the dividend yield. That's a 12.8% annual return over 10 years. A reasonable return in my opinion, not quite what I am aiming for. But again, this is only for the core business aspect of Tencent. If we jump over into my final valuation I want to talk about, we are starting to consider their investments as well. So their core business, I've given them a current value of 800 billion US dollars. This is higher than their market cap, but put in some fair multiples that I looked at from some Goldman Sachs research report, they actually valued this at closer to 900 to almost $1 trillion. I've been a bit more conservative in saying that it's worth 800, which no matter how you look at this business, I think that is a fair assumption to make. Then their investment portfolio, we know their listed portfolio is worth about $220 billion, but they also have a lot of private investments. So I've given the overall investment portfolio a value of $250 billion, which is probably much lower than it is actually worth. Then I've taken the net debt to get our total, and I've applied a holding company discount of 15%. So because they are investing in all these different companies and they really are a major part of their business is just being a holding company, I've applied that discount, which gives us a net asset value of 876 billion at the moment. Then I've gone and applied some growth rates. For the next 5 years, I'm being even more conservative in this valuation. Again, now we're factoring in our investment portfolio. I could use much higher growth rates, but I really just want to give you an idea of how cheap I think this company might be by being overly conservative with these estimations. So 15% for the core business growth over the next 5 years and 10% for our investment portfolio. That gives us our values for 2026. Then I've slowed down the growth of the core business all the way down to 10% for those following years, from years 2026 through to 2031, and I've kept the 10% compounded rate for the investment portfolio, which is about the market average return. They are very diversified, so I think that's a fair assumption to make. It could grow much higher than that depending on what happens in the market, of course. So that gives us our value again 10 years out into the future, and I still apply these same holdco discounts to give us a net asset value or an intrinsic net asset value. So if we're looking at the discount to the net asset value right now, so that's taking this net asset value and comparing it to our current market cap, there's a discount of 40%, just on what the company I think should probably already be worth. Now, if we grow that out into the future, the return we would get from the current market cap to the net asset value 5 years into the future would lead to a compounded return of 25% per year. Going all the way out 10 years into the future, that would be 17% per year. Now, of course, there are a lot of assumptions I've made here that I personally think I am being conservative. If you look at the Goldman Sachs research reports that they have put out for Tencent, I'm being much more conservative than they are. I've put these values very conservative in my opinion. The growth is much lower than I think it actually will be. The holding co discount is more than some people would personally use, and we're still looking at a huge discount to net asset value and some very impressive returns over the next 5 to 10 years. Now, I'll be fully transparent here and say I don't currently own Tencent. I have exposure to Alibaba in China already, which is making me hesitant to overexpose into the Chinese market. However, on my watch list of large cap companies, Tencent is right at the top, and I do think it is very undervalued right now. Of course, none of that is financial advice. You always need to go out and do your own research, have a look at some of the assumptions I've made, but go out and make your own assumptions to determine your own value of what you think Tencent will be worth.
Thanks a lot, Frank. That was a really insightful look into how we can think about valuing Tencent. There's a lot more to Tencent's businesses than I covered in this video, but I hope this was a decent primer to get you started on your way to investigating Tencent. Definitely check out Packy McCormick and Jordan Nell's write-ups on Tencent down below. I want to thank Frank again for coming onto the channel and providing a wonderful valuation for Tencent. Definitely go check out Frank's channel. I'll leave a link to it in the video description below. If you like this deep dive into Tencent, you might like this video over here where Frank and I go into a deep dive for Alibaba. Please like the video and subscribe to the channel if you enjoyed this deep dive into Tencent. I had a lot of fun making this video. Thank you so much for watching. I really appreciate your time, and I will see you in the next video.